What about FMCG? Will this engine start firing up for the bulls as well? What does Q4 have in store? It is time for our special segment, Quarter Se Quarter Tak. And yes, you guessed it, we're putting the spotlight on the FMCG space in this season. Over to Mangalam for the key expectations.
Well, for the FMCG sector, in terms of the fourth quarter, I'll have to use the old ad tagline, same, yet different. Why do I say that? Because it's going to be a quarter of muted staples volume growth with good rural growth. However, urban outlook is improving post the budget and raw material prices remain volatile, but they are higher in the fourth quarter. They have come off as well. Case in point, palm oil itself. There is strong competition across categories, but leaders are making a comeback in a few categories as well. Discretionary like jewelry, beauty and personal care, quick service restaurants, value retail are likely to outperform. And that's something that we saw in the fourth quarter updates that have come so far as well. Jewelry names like Titan and Kalyan Jewelers have, been top of the pops. Trend too, despite growing at a lot slower rate than its own past performance, was among the top quartile with a 28% growth in the fourth quarter. Nykaa continues to outperform the sector, and this time around, we will see some revival in revenue growth coming in from names like V-Mart as well as D-Mart. Jubilant Foodworks continues to do well. The staples, however, continue to drum in their own beats, which are soft and muted. Dabur said its India business will decline in mid-single digits, 150 to 175 basis points margin dip expected as well. Marico, on the other hand, saw a sequential uptick in underlying volume growth, which is a positive, but margins are key to track there. And Godrej Consumer as well, with underlying volume growth expected to be in mid-single digits after a weak third quarter itself. What are we expecting from numbers this time around? We have Tata Consumer reporting, then in the very near future, we have HUL and Nestle reporting as well. Well, if you look at it, from what we saw in the third quarter, not much is expected to change, but a notable underperformance from names like Asian Paints, where revenues are likely to decline 1 to 2%, EBITDA are likely to decline 2 to 6% as well. We're expecting margin compression for both Britannia as well as Tata Consumer. HUL, on the other hand, likely to report low single-digit revenue and EBITDA growth with absolutely flat volumes. So what's different this time around? Well, the expectations of a better FY26 are a lot more due to the projection of a normal monsoon, impact on consumption led by tax cuts and government stops, improving urban demand outlook as well. A lot of acquisitions made by companies in the recent past could start scaling up too. And in terms of valuations, the sector's never been cheap, but this time around, after a spate of underperformance, traded multiples are near 5-year average for most of the companies, and that may give some solace to those looking to invest in the sector at the ebb of a cycle. In fact, very recently, we saw a couple of brokerage upgrades coming by on the sector as well. So if you look at the valuations, compare that to 5-year average, we will see some bit of moderation coming in, maybe the street looking at the cycle to move. What will set this quarter apart from the previous few is that the management commentary may be a lot more optimistic than earlier, which is why weak results may not be as punished as earlier. Therefore, like I said, same, yet different.
I forgot whose tagline that is, Mangalam. My God, I think I'm getting old. Which ad was this?
That's a quiz for all the viewers. Google and find out.
Okay, I'm completely intrigued and I'm going to definitely look this up right after the show. Thank you so much for that. Let's take the discussion forward. We have a sector specialist also joining in. Kunal Vora, Head of Equity Research at BNP Paribas, is with us now. Kunal, everyone's waiting for a revival in these FMCG stocks. Now, as Mangalam told us, the numbers are not showing that up. If anything, we might see a decline now at the EBITDA level for many of these companies, Tata Consumer being an exception. What's your overall stance on the sector?
Yeah, our view on this sector has been negative. FY25 will be another year in which we will not see anything meaningful in terms of revenue growth or EBITDA growth for the year. FY25 will be a year of low single-digit revenue growth. EBITDA could be flat for our coverage. Now, on a very, very low base, FY26 will be a better year. I mean, there has been no growth in FY25, so things will recover in the next few quarters. Rural indicators are looking positive. Government spending, government has done more for affluent consumption compared to mass consumption. So I don't really see that as a trigger. But inflation has started moderating. Raw material cost, agro commodities have been elevated, but that's something which is now stabilizing. So in FY26, we expect the growth rates to come back to more normalized levels, about 7-8%. That's the growth rate which this sector has seen over the last decade. But if you look at, say, 3 to 5 year CAGR, the sector has been a fairly weak one. And besides just the fact that the growth has been weak, we see a higher disruption risk in this sector compared to what we've historically seen. And in that context, we find the valuations to be fairly rich. So our view on the sector remains negative. In fact, from India strategy perspective, this is a key underperform rated sector for us.
Key underperform rated sector. Okay. Though you're expecting for the FMCG, the staples basket, growth should pick up to 7-8% this year, right? Which will be great. I mean, we haven't even seen that kind of number in such a long time. So discretionary consumption is relatively what the market is obviously more optimistic on. I don't know if you cover those companies as well, say the likes of a Eternal or a Nykaa. They represent a different format of consumption. What would your expectation be here in terms of earnings? Will the earnings continue to surprise on the upside?
Yeah, so we have certain discretionary names under coverage. In fact, we also have a basket of 50 stocks which cater to the affluent India. And we believe that affluent India is the story to be in when it comes to consumption. Like you've seen various factors driving it, job creation, rising access to credit, strength in asset prices. All of that really helps the affluent consumption. And some of the names which you did mention, along with like what we cover, like some names in jewelry, QSR, food delivery, all of that really caters to the primarily to the top 10-15% affluent households. Where we see the issue is much more in case of the mass consumption, which is where the staples fit in. And we don't really see anything major changing there. It's been a weak growth, like consistent underperformance compared to nominal GDP growth rate. And that's something which we don't think will change. Now, growth of 7-8%, I mean, yeah, it's a recovery compared to what we are seeing, but nothing really exciting. When stocks are trading at 50 to 52 times FY27 P multiples, we don't really find the 7-8% growth or flattish EBITDA margins to be very exciting.
Kunal, are you allowed to share your top picks on air with us? Please do if you can.
Yeah, we like, in the discretionary space, we like Titan. In case of consumer staples, we do like ITC. And we do like HUL purely because of valuations. The stock is now trading at 1 standard deviation below its historical averages. But growth rate, we continue to believe will be fairly muted for this sector.
All right, Kunal, we'll leave it there and speak again soon. Thank you very much as we continue to track this hopeful recovery, as far as staples and FMCG stocks are concerned on the back of, I guess one of the things, of course, is more money in the hands of the consumer. Well,